Hello, hello. Today I am going to live because I want to go over the 2025 tax season. Tax season just ended. April 15th was the last day. If you have not filed your taxes, I hope that you put in an extension. Um, if you haven't put in an extension, I suggest you go ahead and file your taxes as soon as possible because you don't know if you owe. And if you do owe, you're going to have penalties and interest adding on to the amount that you owe. So I suggest you go ahead and get that filed as soon as possible. But I'm just going to wait a few minutes just to see if anybody pops on. And while we're waiting for others to join, I'm just go ahead and introduce myself. My name is Shavis Watkins. I'm a financial strategist. I work with home care agency owners. I help them organize their accounting records and help them increase their cash flow by 25% with organized accounting and financial strategies. And one of the things that I do as well is prepare my clients for tax season to where they are paid less in taxes when tax season does come around. I'm also a tax professional, so I work with individuals and businesses when it comes to preparing tax returns. So that is a little bit about me. And so, what I want to dive in today, what we're going to go over is like a lot of individuals, a lot of things I noticed this tax season was that the refunds were not as large as a lot of the clients are used to, or they had to pay more in taxes than they were used to paying. So, I want to go over a little bit of the reasons why you may pay more in taxes than you were planning to pay, and also to just take a look at the employees. If you're a W-2 employee, go in there. We're going to go and just go over some strategies that may help minimize the or increase your refund if you want a refund, or just minimize the amount that you have to pay in taxes. And we're going to look at the same for our business owners, of course. So one of the things I want to discuss with my W-2 employees is the W-4 form. That's like the main source right there is the W-4 form that you get from your employer. And they updated the W-4 form I believe it was in 2018 when they updated the form. And so the form is set up to where you are paying just the right amount of taxes that you have to pay. So when it comes to tax time, you're not going to receive the refund that you're used to if you filled out the W-4 form um, based off of your lifestyle, I guess I could say. And what I mean by that is that the W-4 form has to where if you're going to file single, married, it also includes if you're going to take any dependents. And that's the key part right there. Because if you want a refund and you put your dependents, it's accounting for the credits that you would normally receive. And so therefore you receive 2000 per dependent. Now, if you didn't receive 2000 per dependent on your return, that is because you received that. You didn't take, you received that during the year, basically. So that's one of the reasons why. So One of the first things that I go over with my client is the W-4 form. Okay, so how are you filing? Are you filing married? Are you filing single? Single has the standard deductions for single is less than married filing jointly. And so I suggest that my clients select single when it comes to the W-4 form. Also, your dependents. So, do you want more money throughout the year or do you want a refund? And so, for my clients who want a refund, I suggest that they go ahead and put zero for dependents. And that's so that you can be able to get those funds when tax season rolls around. Now, if you want your money throughout the year, which is what I suggest, go ahead and get your. But just know that when tax season comes around, your refund is going to be a little lower. But if you want a refund, a higher refund, then go ahead and select how many dependents you actually have. That way, you will not be receiving as much as you would when tax season rolls around. Another suggestion is because I hear some people saying that they put dependents, like they put a ridiculous amount of number of dependents on those W-4 forms sometimes, and that's because they want to receive all of their money. But when tax season comes around, it's a possibility that you may owe. So just be mindful of that. Um, some other things another item that's on the W-4 form, if you want a refund, is to, and you don't want to owe, I suggest take a look at your check stub. Look at the taxable income that's on your tax stub. Look at the federal taxes that are being taken out. Get the percentage of taxes that's being taken out of that out of your checks right now. If you know your annual income, then you should know the percentage that you are taxed when tax season comes around or during the year, throughout the year. So let's say, for instance, and I pulled it up, I have it in front of me, the tax brackets. So say, for instance, you make 50,000, you know you're going to make 50,000 at the end of the year, right? So if you make over 47,000 like and $47,150, did I say if you make over, I'm sorry, if you make over 47,150, your tax rate is 12%. And so you could be taking out 12% worth of taxes on your return. I mean on your check stub. So go ahead and get that percentage and know your tax rate. That way you'll be prepared when tax season comes and you won't have any surprises. And mind you, you may have a credit, you may be able to itemize. Like some of those things do um, take part in knowing if you'll receive a refund or not. And they do have a source or a calculator on irs.gov that you can always go to. You could put in like your deductions, if you want to itemize, basically, if you're filing married, single, if you have dependents, it'll go through all of this for you. It's a list of questions. And I suggest if you decide to do this, to have your tax return, your 2024 tax return by you and go through the questions that they ask on that calculator. And it will give you an idea of how much you should be taking out per check when it comes to your checks. So with that being said, let me just go break down the tax brackets for you. The 2025 tax brackets are the percentages. So it starts from 10% and it goes to 37%. So 10% of your taxes is if you're making less than 23,200. And that's married filing jointly. I'm sorry. I should have mentioned that before because your married filing jointly is going to be different from your single. So just know that much. So if you are married filing jointly, your 10% rate is on if you make less than $23,200. If you're single, you will pay 10% in taxes if you make less than 11,600. And it goes on from so you have your 10%, you have your 12%, which a lot of us fall in the 12% and the 22% tax bracket. The 22% tax bracket is if you're single and you make and your income is over 47,150. And if you are married, it is if you make over 94,300. Now, if you did I say that right? 94,000. Yes, that's at the 22% tax rate. So 47,150 up to 100,525 if you're single. And then if you are married, your rate is 22% if you make up to 94,300, more than 94,300, up to $201,050. I hope you all caught that. And the 12% rate is if you make over 11,600 to 47,150, and that's if you're single. And 23,200 up to 94,300 if you are married filing jointly. So that's why I say most of us fall within that 12% to 22% tax bracket. And so another strategy I would like to present to you that will help you if you are employee, because I know a lot of times you work from home and you want to take your deductions, your home care. I mean, your home office deductions, but you can't take your home office deductions if you're a W-2 employee. I know it's not fair. I don't think it's fair either, but that's what they decided to do. So, other ways we can do this, and I know like years ago, everybody was like, purchase a home. It'll help you save in taxes. That's not really the case anymore. And the reason why that's not the case is because of the standard deductions. We all know that they've increased the standard deduction. And what this means is that if um, if you purchase a home, pay taxes on a home, pay interest on a home, it has to go over your standard deduction. Now, some of the other things, if you do have a home and you're paying taxes on your home and you're paying interest on your home, some of the other things you can do to raise your expenses to where you will be able to itemize. And when you itemize, you're able to take more from your taxable income. It will lower your taxable income, which in turn will lower your tax liability. So with that being said, if your standard deduction, let me go over the standard deductions, how much they are for the single, the married filing jointly, and the head of household. So the standard deduction for the single is 15,000. Standard deduction for married filing jointly is 30,000. And these are the 2025 numbers I'm throwing at you here. And the standard deduction for the head of household is 22,500. So in order to itemize, you have to go over the standard deduction. So basically, your taxes that you pay on your home, your interest that you pay um, on your mortgage, those items go towards your itemized amount. But normally that's not enough, especially if you're married. And normally it doesn't go over the 30,000 mark. But some of the other things you can add to this is your charitable contributions. Um, keep up with how much you're donating. Keep up with the tax exempt organizations, not giving your kids some money, not helping a family member. That is not, they're not tax exempt. It has to be it has to be an organization that is tax exempt. So if you give to these charitable organizations, even if you're giving close to Goodwill, giving close to what is it? I'm gonna say Purple Heart. If you're giving clothes, appliances, computers, electronics, quilts, socks. We got to think about, okay, let me not go too far because we have to think about these things do depreciate and they do take that into account when doing your taxes. But the point I'm trying to make here is that if you keep up with these things, they will add to your taxes and to your interest. And that will help you to reach that itemized deduction. Some of the other things you can look into is medical. Did you have any medical expenses this year? Did you have surgery? Did you have your glasses? Did you have to go and get purchase glasses, contacts? Those things go towards medical. Now, the thing with medical is that it's another catch to it. With medical, they're not going to take 100% of your medical. They're going to take a percentage of your medical, and it's based off of your income. So I just want to put that out there. But I'm presenting these things to you to help you um, see other ways in which you can lower your taxable liability so you won't be surprised when next year rolls around and tax season comes and you're not receiving the refund that you expected or you owe. So I think that is so I went over for the W-2 employees. I went over the W-2s. I mean the W-4. I'm sorry. I went over the W-4 and some things you can look at. Went over your check stub, some things you can look at on your check stub. We went over the tax brackets so that you can um know how the percentage rate in which you are taxed. Knowing these things up front can help you. Also, we went over the standard deductions. So now let's talk to the self-employed individuals. These are, this is my family, my self-employed family, my home care agency owners, and everyone else that falls into the bracket. But you know where, um, yeah, I'm gonna leave that. Um, but the thing is, to my self-employed, what I want to stress to you all is keeping up with your income and your expenses. Keeping up with your income and expenses. Okay, so have your expenses organized. You know, that is my thing right there. Keeping your financials organized. Because you don't realize how much you're actually spending on your business. Even if you're a startup, keep up with it because even if you are not ready to open your door just yet, keep up with those expenses um, that you are accumulating to open your door because these items can be amortized. So sorry, I can't say that right that good. But yes, you can use those expenses. And you can also write off, I believe last year was 5,000. You can write off 5,000 of those expenses upfront, straight off the bat. And that will help lower your income that you receive your from income from your home care industry, from your trucking company. You know, it can help you reduce that taxable liability, even if you haven't had a client. If you're ready to sell, you can write these things off on your tax return because a lot of times you open your door and you don't have clients right then and there at that point in time, but you are ready. You're just waiting for the clients to come. So even if you do not get one client, we see it a lot in for our for our for our clients that rent out their homes. Like they went and they have, did a lot of upgrades to the homes. They have to keep on electricity because when they're viewing the homes, even with viewing the homes, that's marketing right there. These are some expenses that you can use. So the minute that you are done repairing the home, the minute you are ready, the minute you put that sign out there and say for sale and you're ready for somebody or you say for rent and you're ready for someone to come in and come in and fill the contract out and start paying your rent, their monthly rent, then that is when you can start writing that item off on your tax return. So, so yeah, I'm saying that all of that to say, keep up with your expenses from the beginning. If you are, um, if you're getting a DBA, if you're getting your LLC, these are expenses. So, yes, keep up with your expenses. And the reason for that is because, as I mentioned before, you could be leaving money off on the table. So let's go over some of the things that my self-employed family may run across, or some of the things to help you for those that are already established. I want to start talking to those that are established that are making like a profit. Because I know a lot of us go into business or start a business so we can operate at a loss, so we can take these deductions when it comes to tax time to lower your W-2 job taxes. So one of the things I want to stress is that the government looks at um, a business is you're in business to generate a profit in so many words. So you're not in business to operate at a loss. You're not, even though it happens. But when it's happening, we need to have that information to show that we are operating at a loss. But for those that are making a profit, then we see how those taxes can affect our profit. So we know that we are taxed at 15.3% as a self-employed individual. Not only are you taxed at 15.3% on your profit, and this is your revenue less your expenses. So this is the bottom line that I'm talking about here. So we know that that bottom line is the 15.3%. Now, you also have to pay federal taxes on that 15.3%. I mean, I'm sorry, not on the 15.3%, on that profit. Now, they do give you some kind of leeway because I know that I believe 50% of the profit is what you're taxed on. So, but you're still going to be taxed on it. So, some of the things that we can do or look at is to look at your 2024 tax return. Did you owe? Did you owe the IRS this year, this tax season, on your 2024 tax return? If you did owe, look to see if you can start paying estimated taxes. So a way that you can determine what your estimated taxes are is to go off of your profit from your 2024 tax return. And this is us preparing for 2025. 2024 is gone. We need to prepare for 2025. And so if you are not certain about your estimated taxes, go ask your tax professional. Ask them if they can generate an estimated tax form for you to show how much you should be paying in taxes quarterly. Now, one thing too is that if you're keeping up with your It's a lot that comes into it as well. Because, okay, where was I going with this? Because I started getting sidetracked with the estimated taxes because it is so much involved, even though you're paying the estimated. Okay, so if you have a W-2 job and you are self-employed, even if you are, okay, even if you're an S corp, correct? You're paying yourself as an owner as an S corp. At least I hope you are. You're paying yourself as an owner, as an S corp, right? If you're paying yourself as an owner, you're taking taxes out of your W-2. So those wages are still an expense. So I'm going into a whole nother thing, but it could help you basically because those wages are expensive, but still you have to account for those wages, your W-2 wages. The thing is that you've been paying taxes on those W-2 wages, right? So therefore you've been paying some taxes out. So I said that to say when I'm talking about the estimated taxes, some of the times, sometimes you have to take a look, even if you go to your tax preparer and they generate a 1040 ES, which is it allocates how how much you should be paying in taxes quarterly based off of your 2024 tax return. So that is going to show your total amount of taxable income in there. Mind you, not all of that taxable income is not all of that taxable income. You don't have to pay taxes or estimated taxes on all of that taxable income because you're paying taxes on part of it already through your W-2. So I hope I explained that a little well. So take into account your W-2 wages when you're looking at your your estimated taxes. And get a professional, get your tax professional, get your accountant, someone to help you with this. Because another thing I want to point out when it comes to your estimated taxes and paying quarterly is that you are required to pay taxes as you receive income. That's why the quarterly taxes are there. That's why taxes are taken out of your wages every paycheck because your employer has to pay quarterly taxes on that because it's due. So the thing is that if you're keeping up with your financials and you know that you made this revenue, um, you know what your bottom line is, you know what your profit is. The thing is that you can take that. Mhm. So basically, from January through March, you keep up with your revenue, you keep up with your expenses, you know what your profit is. Go ahead and say, okay, it's 15.3% on this profit. So you'll be able to go ahead and pay taxes on that profit as you're going. Now, sometimes you can, it's what you're paying is estimated taxes, so it's not going to be exact. So they do have, I believe it's the Pearl Harbor rule, and it lets you know that either you pay 100% of last year taxes or 90% of this year's estimated total. So that's something to look into as well because if you don't pay quarterly taxes or if you're not paying taxes throughout the year, it is a possibility that you will be penalized if you're making a profit. So that's why I wanted to bring up the estimated taxes because it is important to know or to have an idea about how much you should be paying quarterly on your business taxes. And so with that being said, I'm gonna go ahead and give you the when the estimated taxes are due per quarter. So it is 4 quarters. I'm looking at my comments over here. Christy says, yes, home office isn't fair. Laugh. Yes, it's not. She's when I mentioned home office earlier. Yep, you're working from home, and then they're not allowing you. to to write off your home office if you're an employee. I don't think it's fair either, as I mentioned before. Yep, it's almost impossible to go over the standard deduction. I do agree. Okay, I have a question here. Hey, Paula. Hey, Christy. Okay, so it is, let me bring this over here. Are you at risk for an audit if your business continuously is in a default annually? Um, To be honest, I don't know how the IRS picks the individuals or the businesses in which they're going to audit. So my suggestion is just to keep your records because it is possible that you will um, operate at a loss year after year after year after year, as long as you are in business to generate a profit. So that's the key right there. So you're doing everything, you're doing your marketing, you're doing you're reaching out to people, you have your services out there, right? But you're just not generating a profit that you are trying to generate. So if you are audited, you can prove to the IRS, yes, I am in business to generate a profit, but um, my business is not going as well as I expected it to go. So those are because if you're operating, I've seen it many of times. So if you're operating at a loss, you're operating at a loss. But the thing is, they're gonna start questioning, like, okay, so why are you still in business? Why are you still doing this if you're in business to why you're still in this business and losing every year. So that question may come up, but the thing is that it is possible. Yes, it is. But I can't answer whether it will, if it would have you at risk for an audit. Thank you for your question. Okay, so we were talking about the estimated taxes, and I wanted to go over the quarters. So for the first quarter is from January the 1st to March 31st. So keep up with your profit, you keep up with your revenue, keep up with your expenses to know if you're operating at a profit during from January the 1st to March 31st. And the payment due, the taxes will be due for that first quarter on April 15th. The second quarter is from April 1st to May 31st. Your estimated taxes are due June 15th. The third quarter is from June 1st to August the 31st, and the payments, your taxes will be due September 15th. And quarter four, five, it is not quarter five. And quarter four is from September the 1st to December 31st, and that is due January the 15th. And see, another thing is that if you have went ahead and generated you made more revenue than what you made more profit than what you expected to make. In quarter four, that is your time to pay when January 15th come around, that is your time to pay more taxes if you need to. So this is why I stress keeping up with your estimated taxes. Some of the other things I wanted to point out for my business owners is some of the expenses that you are able, some of the expenses that you are able to go ahead and use as a business owner, and some of the popular ones at that. One of the ones up front is mileage. So, I know a lot for, let's see. So if you are traveling from your home office to a client, per se, that's mileage. Anything that you are doing for your business is mileage. If you have to go to the store to buy supplies for your office, that is also Mileage. So mileage is a big one. I pulled up the the rate, the mileage rate. Let me see. What's the mileage rate? Here we go. So for 2025, the business use mileage rate is 70 cents per mile. So you can write off 70 cents per mile as a business owner. So that is one thing I would suggest. Now, I would add this. Okay, so if you use mileage, you're not able to use fuel. You're not able to use your repair maintenance because there are two type of ways you can deduct your travel, basically. So you can either deduct your vehicle or do a depreciation on your vehicle. And mind you, when you do a depreciation on your vehicle, if your vehicle is also used for personal use, we have to do a percentage. You have to do a percentage on that vehicle as to how much you're using that vehicle for business use. So we can depreciate that based off of the percentage for business use. Then you'll be able to use your tolls, you'll be able to use your fuel, you'll be able to use your repair and maintenance. So that is when you'll be able to use those items. Um, so keep up with these things because it can help you in the end of it all. Another one is the home office deduction. Even though you're not able to use your home office as a W-2 employee, but let me tell you, as a business owner, you are able to use your home office. If you have a home office, use it. Now, let me tell you, it does have to be a dedicated space just for your home office. And I'm gonna leave it at that. I'm gonna just leave it at that. It has to be a dedicated space for your home office. Yes. And so, what you will need in order to take your home office expense is to know like the square footage of your whole home, the square footage of your home, and the square footage of your office, because they're also going to take a percentage of that. Now, when you're taking your home office deductions, you're also able to you're using your electricity in your home, right? For your business. So you'll be able to do your utilities, your electricity, your gas, your water. These are some things that you'll be able to use as your home office, your utilities. Even if you're not able to itemize, you can use a portion of your taxes. If you own your home, you're able to use a portion of your taxes. If you rent, you're able to use a portion of your rent. So that's why but let me tell I'm gonna add this too. That's if you're making a profit in your business. Because if you're not making a profit, like before using your home office, um if you're operating at a loss, it's not going to really help you. But if you're operating at a profit and we're trying to get that profit down, then it will help a lot tremendously. Okay, and some of the other things I just want to throw out there when looking at deductions for my self-employed individuals is also your phone. Your phone usage, especially if you're a small business, a lot of you don't think that, oh, you're using your business for your phone. I mean, you're using your phone for your business. Yes, your phone. And as I mentioned before, it's a percentage. It's not the 100% that you're paying for your phone bill, unless you have a separate phone for your business. Other than that, if you're using that phone for personal use and business use, we have to do the percentage of what is being used for business use. I think that is. Oh, advertising. Go ahead. If you're advertising for your business, internet, if you're using your internet for your business. I'm just throwing some things out here to help you out. So yeah, so I think we've covered a lot. Let's see, do I have any questions? Okay, I don't have any other questions. If you do have any questions, go ahead and let me know because I will answer them during this time. I hope this information was useful. What we did go over is um how because there were some surprises this year. So I just wanted to hop on to go over some of the ways in which you are able to be ready for 2025 taxes. Before, like right here, we're in the second quarter already of the year. Already the second quarter of 2025. We're already in the second quarter. Let's think about some of these things that we can implement this year in 2025 to where we won't be surprised when tax season rolls around. Look at your W-4s. Go ahead and take another look at that. Take a look at your check stubs. Keep up with your business expenses. If you're a business owner, it's important to keep up with your business expenses. Know how much revenue is coming in. One of my groups that I'm in, what we do is Matrix Monday. And so Matrix Monday is that you're looking at your revenue, you're looking at your expenses, you're seeing how much profit you've made in your business for that week. So that's something that I just want to throw out there, maybe to help a person or two, a business owner or two. And let's see, do we have? I hope this. I know you said this. What is my tax bracket? I would have to know what your income is, Leela. Hey, Leela. I would have to know what your income is in order to determine what your tax bracket is. So we can get on a call and we can discuss that, your tax bracket. But what I mentioned earlier is that the most common tax bracket or the most common percentage is the 12% or the 22%. So that is the most common percentages are tax brackets that most individuals will fall under is the 12% and the 22%. Is this session recorded to go back and listen again? I missed the first few minutes to help reduce my liability. Yes. Yes, this information, I will post it. It will be available to view later at a later time. Yep. Thank y'all for the questions. I really appreciate it. Thank you for watching. I hope this information was helpful. And as always, if you need any help, contact me. My name is Shavis Watkins. I'm with 10 Key Professional Services. I contract with Fam Care Services, which is the tax office. So I'm available for any questions. We can hop on a chat. We can hop on a Zoom. I just want everybody to be prepared. I want our businesses to look great. I want our records to be organized, and I want us to be generating a profit this year without paying a lot in taxes. I hope this information was helpful. Thank you. Bye.